of this session is to really talk about the venture capital, the venture investing community in Kansas City, kind of the state of where venture is, and to really get their perspectives on, how entrepreneurs should be thinking about approaching them, approaching the business problems, those types of things. So I'm going to let you guys introduce yourselves versus me trying to spend my time talking about who you are. So maybe just tell us a little bit about, who you are, organizations that you guys work for, what your kind of focus is a little bit, maybe a little bit of your background, and kind of how you got there. So Thad, we'll start with you.
All right, great. Nice to be here. My name is Thad Langford. I'm the founder and managing partner at Flyover Capital. Kevin and I go back far too many years from my days at Sprint. So it started early days of Sprint PCS, helping to build out the ability to download applications over the air to your phone, which makes me feel amazingly old, but amazing that it was only 2005 when we started being able to do that. Then after that, rolled out and ran a company CEO, president of a company called Zig Networks, which we built up over a three and a half year period, exited Google in 2011. At that point in time, started Flyover Capital kind of after the exit because of the pain that I felt trying to raise capital for a technology-based in Kansas City. Went to the coast and specifically Boston, New York, and Silicon Valley, Sand Hill Road, trying to raise capital, and heard the moniker a lot of, hey, or heard the statement a lot of, love what you're doing, love the company, but you're based in Kansas City, so we're not going to invest there. We fly over you going from Boston to Silicon Valley. So as part of that good entrepreneurial fashion, started Flyover Capital, specifically to invest in early stage technology companies that are not located in Silicon Valley or the Northeast Corridor, and that's what we're doing today.
Carlos?
Thanks, Kevin. Good to be here. Good to see everybody. My name is Carlos Antequera. I am the CEO and co-founder of Novel Capital. Similar to Thad, I think the reason we started Novel was because of our experience growing and building a company here in the Midwest and the challenges of getting growth capital. In particular, in my case, I started a SaaS company focused on the edtech space in the early 2000s. And after getting some traction, getting to $1 million in revenue, growing about 40% year over year with 100 customers, I decided I wanted to accelerate my growth and went out to get capital initially. Like they taught me in my MBA, I created a business plan and went to my friendly banker, and they told me, well, no, you don't have any assets. I was like, I didn't know you needed assets. I thought I just needed a good business and a business plan. I learned pretty quickly that wasn't the case, and then I did the rounds with the angel investors and some other VCs, and they said edtech is not very sexy, it's not very scalable, sorry, can't help you. So eventually the story ended up raising capital after some time from some folks from San Francisco that were interested in investing in bootstrap companies in the Midwest. But the challenges kind of stuck with me, and after I sold my company in 2015, we started Novel Capital with the idea of finding a different way to provide capital to a larger set of entrepreneurs. So instead of providing equity, which applies to a certain set of entrepreneurs and companies that have certain characteristics, in particular super high growth, that are going to have very large exits, we use revenue-based financing, which allows us to provide capital to a larger set of entrepreneurs that maybe have more steady growth, that might not necessarily have that unicorn profile, but they still are good companies that have good products, good customers, and still need capital to grow.
We always hear founders talk about it's hard to raise money in Kansas City because there's just not enough options that match my thesis, that match my stage. There's just not enough volume here. Would you guys think that the opportunity to get other VCs that are outside the area investing in Kansas City companies isn't something we should any longer be, I think, afraid of as ecosystem builders, right? We're always afraid we're going to lose startups because they have to raise money outside the market. How should the ecosystem think about that dynamic now, about raising money outside the market or really be independent or desiring to raise money locally?
So I guess I look at it a little bit more geographically agnostic at this point. We've co-invested with over 80 different groups at Flyover, and so some of those have been located in Indianapolis, some have been located in Silicon Valley, some have been located in Tokyo. It's really across the board, and I think we've done a really nice job of almost kind of taking that component out of the equation. And I hope that Flyover Capital, that we've at least played a part in raising the visibility of the and awareness for investors everywhere that there are significant technology companies based in the middle of the country. And oh, by the way, you can start, grow, build, exit significant technology companies, no matter where you're located, and you don't have to be in Silicon Valley or Boston or move to New York to be able to be successful. That's just not the case. And I think that thesis now is resonating and is much more known. And so therefore, then you will have investors now that are interested and will look at companies that are based outside of their own areas, which I think is a net positive for everyone involved.
Yeah, I would totally agree with that. And to the point that you were making, Kevin, about people saying that people in Kansas City may be at risk averse, or there's not enough money, or enough money that's taking risk, but there's a lot of money around. Interestingly enough, in my experience, I hear that in a lot of places. Thad and I are part of a group called Kaufman Fellows, and a couple of years ago, the gathering was in Tokyo, and it was surprising to me to hear those. I could have closed my eyes and felt like I was in Kansas City, right? And people saying, well, in Japan, people are very risk averse, right? They don't want to invest in technology, in new technology. They want to be kind of associated with a big company. If you're not associated with a big company, then they won't take a risk on you. I went to another conference in Miami where I was in a panel. The exact same conversation. People in Miami only like to invest in real estate. That's what they know. They're risk averse, right? So it's really about identifying what type of partner you're looking for and what type of tool you're looking for, right? In particular, in our case, we think our capital makes more sense when you figured out your unit economics and when you really understand who your customer is and when you have product in market. And you're taking in a way some of the risk away of the process, and so you can get capital at a lower cost than equity. But at the beginning of your company, when you're taking more risk, maybe equity is the right tool for you. So it's also about choosing the right tool before you even identify what type of partner you want.
Yeah, it's I would recommend, if you haven't read, I was just rereading The Power Book, and it's a great thesis on kind of the history of venture capital, talks specifically about some of the evolution and where venture capital is going. And if you're looking to raise money, I would encourage you to, understand the VC world, understand the investors as well as you understand your customer. I think that's a great point. One of the things rereading that book has brought back to mind is Arthur Rock's principle. Some of the things have stayed the same since the very beginning, since the very inception. Since the 60s, and that is the idea that you're investing in the founder. And that first kind of pivot that the VCs made to say, hey, instead of just thinking about the business, let's think a little bit about the founder. So to that point, what do you guys look for in founders or teams specifically? Is we always talk about jockeys and horses, so let's talk about the jockeys for a minute. You guys invest in kind of that jockey mentality of who is running this company. We're going to invest in the founder and the team as much as the business, and if so, what do you look for in that founder or that team? We'll start with Carlos, so he doesn't have to keep saying he agrees with that.
I disagree with that. What might help is give a little bit more context. And, a couple of times I mentioned that the type of capital we provide is not equity and how that is different. So what we do is we provide non-dilutive capital in an instrument that we call a revenue share instrument. And so the way it works is instead of providing an amount of capital in return, have a percentage ownership of your company that at some point we expect when there is a sale or a positive outcome, then we get our money back. We will get a revenue share of your as a percentage of your revenues on a monthly basis until an agreed amount. So because of that, one of the key requirements for us is that you have revenue. In particular, in our case, we look at entrepreneurs and companies that have at least $500,000 in revenue, and usually our sweet spot is up to $10 million in revenue. And so, as a rule of thumb, we can provide between 20 to 30% of the amount of revenue that you have. And so, we are much less focused on the entrepreneur themselves, because our process is very data-driven, right? So we have a digital platform in which we're able to access your financial information, your banking information, in some cases your CRM information, and we combine all that data to be able to assess how much capital we can provide to you almost in real time. And so because we're taking almost a very data-driven approach in which, in many cases, we are not talking to the entrepreneur when they come to our digital platform directly until later, or if they have questions, we think we have a very equitable process. We're almost reversing the approach of looking at data first and results first, and if the results are there, I don't care what color you are, what height you are, right? You have a business and you are executing, therefore I will provide capital to you. I think it's the right risk. So that's how we think about it.
And I think, for us, we invest early stage, meaning sometimes it's, product is built, maybe there are one or two founders kind of in the business that have started it. So if the product is, still pretty early on, the market traction is pretty early on, the one thing we have to go on is essentially the team and the founders and the belief that this team is the team that can actually go make it happen and really be successful in the end. And so, we do dive pretty deeply, alongside of the entrepreneur, and we want to buy in to the story. We want to buy into the vision. And in so many cases, you do want to know and kind of want to know the background, like, what was the genesis of this idea? How did you get involved with this? Because a lot of that attachment to the idea and the knowledge and the domain expertise is really the key driving force behind the success of the company, at least the early stages of the company. I do think also, just kind of from a self-awareness standpoint, that's something we really look for in entrepreneurs and founders. No one has everything covered. At the early stage, there are gaps everywhere. There are single points of failure everywhere. So we don't expect for all the answers to be that, for the founder to have all the answers, to have every gap filled. But what we do want is to know that they've thought about it and that they're aware of those, and that they, once they get capital, they have a plan to address them. And those are some of the conversations. That's what develops over time, which is actually interesting. One of the things we hear is, wow, it takes you a while to kind of get to a yes or no. It's like, look, you're not going to come in and pitch for 45 minutes or 30 minutes, and then we say, yeah, we're going to give you $2 million, for this business. I'm always, always push the founder to say, look, you want to get to know your investors prior to accepting money from any group. And the best way to do that is kind of through this back and forth process of getting to know each other, getting to know each other's business, how you operate.
Yeah, not all money is equal, right? Like not all money is good money. So being strategic about it is important. So whether it's with your firm or with the connections you guys have, Carlos, you referenced working within the ecosystem of other investors out there. What's the single biggest mistake you see entrepreneurs making when they're approaching potential investors?
Just one.
List them off, Thad. Let's hear them.
Well, I think one of the things that I think gets dismissed pretty early on or gets glossed over is what I alluded to earlier, is the attachment to the business and the passion for the business. So in so many cases, when entrepreneurs will come in, they'll immediately start pitching and talking about the product. Here's the TAM. Here's the way we're going to address it. Here's the solution. And they go through just again, it's that generic kind of walkthrough of what everybody thinks VCs want to see. And we do, and we want to see that. But what gets glossed over and missed many, many times is that story up front. I mean, look, we're looking for, we want to get excited. We want to get excited by an idea. We want to get excited by the entrepreneur. If you focus so much just on the product solution and just kind of go through the generic slides without the backstory, without this attachment, without the passion component, and bring that enthusiasm so we can feel it along with you as you tell the story, then it's a miss. Because you got to remember, we see 600 deals a year that we're looking at. And so you really are looking for something that stands out, and what really makes a story stand out is that enthusiasm, that passion, yes, the knowledge of the space, just the thoughtfulness that you bring. And so the biggest mistake I see is entrepreneurs glossing over that.
I would go back a little bit to one of the original questions, which I think is the understanding of who you should reach out to, what type of investor you need to reach out to, and once you decide that, do your homework and really find out. So for example, Thad, he's giving you the formula of what he cares about here. You go talk to a different investor, they might care about something else. Understand what industries they invest in, understand what check sizes do they write. And it's all kind of the basics. If you are looking for a 100K check and the investor, their minimum size check is $1 million, it doesn't matter what you do or how great your idea is, you just don't fit their model. Or vice versa, right? If you're looking for a $20 million check and somebody has a maximum of $500,000 per check, it's not going to work. If somebody, I don't know how many times, even before when I was doing angel investing, people would come with healthcare ideas to me about, some drug they're working on or something else. And if I invest in something in software, right, you could be curing cancer and it could be great and you could be the best, smartest person. I just don't do that. I don't know that space. So I think just understanding the basics of what is the thesis of the investor, what size check do they write, what geographies do they work in. There are a lot of geographically focused investors, right? They're trying to support Detroit and their ecosystem, right? So it doesn't matter again what your idea is. If you're not in Detroit, you're not going to get their capital.
So let's talk about that taboo subject of, you're trying to research, I say taboo, I think from a startup perspective sometimes, the role of the gatekeeper, or do they really exist, right? So how do you guys, do you have, when an entrepreneur wants to approach your firm, how do they do it? What advice would you give to an entrepreneur in terms of engaging with your firm specifically, or more generally, when they've found a firm or they're trying to get that research or they're trying to get that information that might not be as publicly available? How should they approach things then? How should they think about this, the world of gatekeepers? And do you guys think that that's a real issue from the entrepreneur's perspective?
Yeah, I guess I'm thinking about it in terms of our own firm. I wouldn't say we have gatekeepers. I mean, we're a small team, so it's really, for me, it is. We do get as you can imagine, there's a lot of cold emails coming in. To Carlos's point, it's very clear they've done zero research, that this is just a mass marketing email campaign, and it kind of ruins it for everyone else. Because then all of a sudden it's just like, look, I'm not looking at cold emails because there's just so many of them and I can't tell which ones are actually, tailored and really specific to us or not. So really the best lead in for us is having a warm lead, is for the entrepreneur to have a warm lead in some way, shape, or form, or craft something that is very apparent that you've done your research and homework on the firm, and this is why we are a fit for you, or potentially a fit for you, or you should be talking to us. And those stand out immediately, and those usually get attention. I mean, our job is to look at deals. Now, again, our job is to do it very quickly. And if they're in our sweet spot and kind of in our target, which is, hopefully our website is very easy to do. Hopefully it's very apparent what the sweet spot is. So I think one of the best ways to do it is either have a warm lead in, kind of with a warm intro, or craft that communication that makes it very apparent. Again, you've done your research and that we should be talking to you.
That warm lead, is that a portfolio company lead? Is that an LP? Is that what's a warm lead? Because I think when I say gatekeeper, that's kind of what I mean. It's how do you get a warm lead to a firm you don't know any of their ecosystem, any of their network?
Yeah, I guess definitionally, I think of gatekeepers as somebody that's kind of their job is to basically stop things from coming in, right? Kind of at the gate and saying, okay, no, you're not a fit, et cetera. I think it's just, a warm lead can come from a lot of different places. Certainly from our other entrepreneurs, the entrepreneurs that we invest in, the founding teams that we invest in, are our best source of deal flow because they know us, they know what we're looking for. They're very discerning of the other entrepreneurs as well. So they're very quick to kind of say, you know what, yeah, you absolutely need to talk to this entrepreneur, or you know what, maybe not so much on the other. Our LPs, so our investors and our own fund, are a great source of deal flow as well. Being at conferences, just kind of events is another great source of deal flow. So that's not so much a warm lead, but it is in a way, because the get-togethers in some way, shape, or form actually create the warm lead as well. So anyway, so I think that the definition of warm lead for us, it can come in a lot of different forms.
I think it is important to do that homework to understand really, and then you were saying, well, how do you get that warm lead? And again, I think of it just again from my entrepreneurial nature, it's just like a sales process, right? So if you're trying to get to a prospective customer, how do you get to that prospective customer if you don't have a natural intro to them? Well, you figure out creative ways to get there, right? So some you could use kind of guerrilla marketing tactics, and that goes to, can you craft an email that is so compelling that gets somebody's attention, right? Can you look at you can look at the portfolio of companies that most firms will have the list of the portfolio companies. Can you find somebody in those portfolio companies that can make that connection, because that they will respect that? Can you identify the limited partners of the firm that might be able to, they want to help their VC firms and they might be able to make an intro. So it's about getting creative, it's about doing the work, and part of it is just doing the heavy lifting and the kind of the busy work of figuring out if you think that's a good match, then it's worth your time and it's worth your energy, but then there's some hard work there. You can get a hold of us as well. And the other thing that I would say is, just be, with anybody that you're talking with in the organization, just I think as a professional nature, be thoughtful, be kind. Don't think that because somebody has an apparently lesser title, they don't deserve your time and attention and your best effort. In our team, we get that sometimes where entrepreneurs will, see somebody that in their eyes, it's not worth their time talking to. But those are the folks that we've hired and we think they're competent and they're going to make decisions. And if they don't get treated right, or if they don't get provided information that they need to make the decision, guess what? You're not going to get very far.
All right, this next question is a little like voting on Major League All-Stars. You can't vote on your own players, so you can't say your own firm. You guys are both in Kaufman Fellows or have been part of Kaufman Fellows, so you've got a pretty interesting view of an ecosystem of investors and types of investment. What, in your opinion, is the most innovative thing that you see on the horizon for venture right now? What are the approaches that you think, and you can't say you, what are the most things that are out there that you think are, we should be looking for in the venture space? Still can't say Flyover, that.
Novel.
See, you learned the game. Yeah.
I actually think, and this is in the very beginning stages, but I think the idea of how to utilize the blockchain from an investor standpoint, so a lot of DAOs that have been created, so groups of investors, essentially utilizing the decentralized aspects of the blockchain. Again, I think there's going to be a lot of innovation, kind of utilizing the underlying infrastructure, not just the currency standpoint of crypto, but the actual decentralized nature of the blockchain. I think that is fundamentally going to change potentially decision-making from an investment standpoint. And so I think that there's going to be a lot of innovation that's going to come with that. I can't sit here right now and articulate exactly what that is going to look like, but I do know that there are groups, and even within Kaufman Fellows, that we're kind of looking at these types of structures to try and figure out, all right, what are some of the interesting components and how to utilize it effectively.
All right, so we're at times, but I got one more quick one for both of you. The one that got away. Every VC's got one, right? Every investor's got one. Your process might eliminate in that a little bit, but the one that got away.
Yeah, in our case, as you mentioned, really for me, there's not a good way to think about it, because if a company is a high flyer, usually we're not a good fit because many of the characteristics are not a match. So actually, I almost think about the opposite, because it's like which one got in that shouldn't have. Because in our model, our loss acceptance ratio is less than 10%, right? So if you think on the venture equity model, you're going to have your high flyers and you're going to have the ones that are just might go to zero, and that's the model is built for that. In our case, out of 10 companies that we provide capital, ideally all 10 are successful and make it through the journey, and if there are any losses, should be very, very minimal. So for us, if somebody passed through that we didn't provide capital and they did fantastic, good for them. They're probably not a fit to our model.
Guys, I want to thank you both again for being a part of this first week of what we're building here. I really appreciate your time. I appreciate your insights. We'll have you guys back at some point to talk about, especially, Carlos, no offense to that, but Carlos is early in this journey with this model. I think we want to hear more about how it's going as you get a little further down the path. So thank you both.